Okay, I make that 4 o'clock by my watch. So good afternoon, everyone, and a warm welcome to the webinar today entitled "What Does Your Pension Statement Really Mean?" Where I'll be shedding some light on the information contained within your recently received pension statements and hopefully enable you to gain a better grasp as to what your pension benefits will be in retirement and how you can go about saving additional money for retirement in an extremely tax efficient way by using a benefit that's exclusively available for NILGOS members. So as you can see on the screen there, my name is Nick Pottinger and I'm one of the retirement education specialists here at AVC Wise, and I've worked in financial services for over 20 years now. The last 9 of those years I've been working exclusively in the local government AVC sector, where I've helped thousands of people understand what a great employee benefit the shared cost salary sacrifice arrangement is and how they can use it to save extra money for retirement and potentially help them retire earlier. A few things to make you aware before we start today then. So the content of this webinar is provided for educational purposes only and does not constitute financial advice. And the information given is based on our current understanding of taxation legislation and regulations. Any levels and bases of and reliefs from taxation are subject to change. And tax treatment is based on individual circumstances and may be subject to change in the future. And investments can fall as well as rise, and past performance should not be used as a guide to future performance. And finally, any figures discussed today are for illustrative purposes only and are not guaranteed. So what are we going to be having a look at today then? Well, first of all, we're going to break down the information contained within your pension statement. There's a lot of information contained within these statements, which can sometimes make it a bit confusing to read and pull the relevant details from. So we'll take a look at a case study to break this information into bite-sized chunks to make it easier to understand. We will then take a look at the benefits you're entitled to, depending on the sections of the NILGOS pension scheme you've been a member of, and when you're able to take those benefits in retirement. And lastly, we'll talk a bit around about what your options are for increasing the benefits you receive in retirement by using a unique option, which is exclusively available to you, with you all being members of NILGOS. Okay, so first of all then, I just want to introduce you to a colleague of yours called Sarah. So what we're going to do here then is use Sarah as a case study, where we can first of all break down how the membership of NILGOS is accumulated in an easier to understand way. So when we do take a look at the actual pension statement in a few moments' time, you'll be able to see how the different segments of the pension statement correlate with the information we go through here. So Sarah's an employee and she's been a member of NILGOS for quite a while, and her normal pension age is age 67, as her normal pension age is now linked to her state pension age. And when Sarah gets to age 67, it's estimated that her final salary will be just over £29,300 or so. So as I've mentioned, Sarah's someone that's been in the NILGOS scheme for quite a long period of time. So she's built up membership in all the different sections of the scheme. And as some of you here today might be aware, the NILGOS pension scheme has changed a number of times over the years. So let's see what Sarah's built up in each respective section of the NILGOS scheme. Okay, so the first section that Sarah built up membership in then was the final salary 80th section. And this was in operation up until the 31st of March 2009. And this section worked on the basis that for every full year of membership in this section, you would build up 1/80th of your final salary as an annual pension amount in retirement. And Sarah was a member of this 80th section for 1 year, and she built up £393 of annual pension within this particular section. And it's also worth mentioning that within this section, you'd have also built up an automatic entitlement to a tax-free cash lump sum, which is 3 times the annual pension amount. And I'll go into a bit more detail on that in a few moments' time. But Sarah's also got 6 years of membership in the final salary 60th section of NILGOS, and this ran between the 1st of April 2009 to the 31st of March 2015. And this section is calculated based on what your final salary is, but instead of you building up 1/80th of your final salary for every year of membership, in this section you're instead building up 1/60th of your final salary as an annual pension. So this section, you've actually been building up more annual pension in comparison to the 80th final salary section, as if you imagine a cake being cut into slices, a cake cut into 60 slices is going to have bigger slices than a cake cut into 80 slices. But it's important to note that there is no automatic tax-free cash lump sum that was being built up in the background on this 60th final salary section. That was purely in relation in relation to the 80th final salary section that preceded it. So Sarah was working full-time over the full 6 years this final salary 60th section was in operation, and therefore built up the full 6 years of membership, so 6/60ths of her final salary in this section, amounting to £3,142 of annual pension income there. But the vast majority of Sarah's pension was actually built up in the career average revalued earnings section, also known or abbreviated to the CARE section. And this is a section that everyone here today, doesn't matter when you join Nilgos, you'll now be a member of this CARE section. And this section came into place from April 2015. And in this section then, for every full year of membership, you build up 1/49th of your annual salary within that year as an annual pension income for when you retire. So say, for example, your salary was £49,000 and you're working full-time over a full year. In the CARE section, you would have banked £1,000 of annual pension income per year in retirement for yourself. So the difference then with a career average section compared to the two final salary sections that preceded it is that the career average section takes each year in isolation when calculating your retirement benefits, whereas the final salary sections calculate generally based on the salary that you end up finishing work on. But one important thing to note here is that the career average revalued earnings section, as the name suggests, it is revalued each year in line with the consumer price index to ensure the 1/49th of your annual salary that you're banking each year as a pension amount is going up in line with inflation and protecting the buying power of your eventual pension income. So Sarah ended up accumulating 18 years of service in the CARE section, which amounted to her having an additional annual pension amount of £10,742 in that particular section. And with all those sections added together, then it meant that Sarah's annual pension, with 25 years of Nilgos membership spanning all three sections of the scheme, her total annual Nilgos pension amounts to £14,277 a year. And she did also build up a small automatic entitlement to a tax-free cash lump sum of £1,106, as Sarah only had 1 year in that final salary 80th section. And some of you here today, I'd probably expect, would probably have far longer service than Sarah did in that 80th section. And as a result, you'll have a much larger automatic tax-free cash lump sum waiting for you when you retire. Okay, so we've just established then that Sarah's entitled to an annual pension amount of £14,277 and a small automatic tax-free cash lump sum in addition to that of £1,106. And of course, on top of the benefits you can see on the screen there, Sarah will also be entitled to her state pension benefits as well. And the state pension is approximately just over kind of £9,500 a year or so at the moment. Okay, so now we know what benefits Sarah's built up in each respective section of the Nilgos scheme. Let's just take a look at her pension statement to see how this information is laid out for her there. So what you can see on the screen there then is an example pension statement for Sarah. And as you can see, there is a lot of information contained within the statement. And this information is broken down into different segments. Now, your pension statement may not look exactly like the one for Sarah here. And it might be that yours is presented in a slightly different way. But all Nilgos statements will contain the same basic information broken down into the various different segments. So what I'm going to do here is take you through each segment of the statement and break down the relevant information contained within them. Okay, right, so the first segment of the statement contains your personal details. So you just want to make sure that your name, your national insurance number, and the payroll reference is correct by perhaps cross-referencing it with one of your payslips. Now, in the top right-hand corner, you can see it says last day of service, and this is where it will give you your normal retirement date within Nilgos, which is now linked to your state pension age. So for some of you here today, it could be 65, age 66, 67, 68. In Sarah's case, her last day of service is shown as the 1st of April 2032, which is her 67th birthday, and this aligns to her state pension age. You can also see the section where it says final pay, and that's where it estimates the final salary you'd be on up until the point of leaving employment. And this is a salary that the statements will be using to calculate any benefits you may have built up within the final salary sections that ran up to the 31st of March 2015. And in Sarah's case, her final pay is estimated to be £29,311. Now, below that first segment of the statement, then you can see a box where it says pension benefits summary payable from the 1st of April 2032. And this is where it's going to give you the projection as to what your NILGOS benefits will be at retirement at your normal pension age. And it does this by adding up all the sections of the scheme you've been a member of and will be a member of up until the point of your retirement. So we can see here that Sarah's annual pension before income tax or any other deductions is coming to that figure we looked at earlier of £14,277. So in this case, it's all the membership she's already built up in the NILGOS scheme with the final salary 80th and 60th sections, along with the service she's built up so far within the career average 49th section, and also factoring in the projected future service you'll have within the 49th section until her normal pension age. And that's what makes up that £14,277 projected annual pension figure there. Now, this next box underneath then shows us Sarah's retirement grant, which is the automatic tax-free cash lump sum you're entitled to. So if you have any membership within the final salary 80th section that ran up to the 31st of March 2009, you'll have some form of retirement grant. And as we know, Sarah had 1 year of membership within that 80th section where she's entitled to a £1,106 automatic tax-free cash lump sum. So if you don't have any membership within the 80th section as you joined the NILGOS scheme after the 31st of March 2009, you will not either see that retirement grant box or on the statement it will be showing as 0 if you've got no service in that 80th section. And then on the last box of this statement, then it shows you the annual survivor's pension. And this is the part that details what annual pension amount your spouse or partner would be entitled to if you were to die whilst in retirement and leaving a dependent survivor. So in the event of Sarah's death, where if she was to pass away before her spouse or partner, in this example, we can see that the survivor's pension pays out an annual figure there of £4,634. Okay, so let's move on to another part of the pension statement now. Now, on this segment of the statement, then you'll see the service box, and this is where it details the amount of service you've built up in each respective section of the LGPS. So it's been broken down into the 80ths, the 60ths, and the career average sections. So we can see here that Sarah has service of 1 year and 0 days in the 80th section. She also had the full 6 years and 0 days in the 60th section. And then it's showing that by the time Sarah reaches her normal retirement age of age 67, she will have 18 years and 0 days in the career average care section of the scheme. And then the box below, titled Calculation of Benefits Annual Pension, breaks down how her predicted annual pension at retirement age is calculated. So Sarah had 1 year in that 80th section of the of NILGOS, which gives her an annual pension amount of £393 there. She also had the 6 years in that 60th section, which gives her an annual pension amount of £3,142 there. And as we know, the majority of Sarah's pension benefits were built up in the career average revalued earnings section, where she had 18 years of service and built up a further £10,742 of annual pension income there. So when Sarah gets to her normal pension age, which is age 67 in her case, her total NILGOS pension with all those sections combined is that figure we showed earlier on the case study of £14,277 a year. And remember, that will be in addition to her state pension benefits she'll also be entitled to. Okay, so let's move on to one of the final segments then of the pension statement now. So you can see in the box here titled Annual Survivor's Pension. This is what your surviving partner or spouse will be entitled to in the event of you passing away whilst in receipt of your NILGOS pension. And in Sarah's case, as we know, her survivor's pension amount would be £4,634 a year, and they'd be in receipt of that amount until their death. And then you've got this final box here, which breaks down some information relating to the overall government limit in place for everyone in the United Kingdom, and is what they allow you to build up as a total equivalent cash value in all of your pension plans over the course of your lifetime before you face punitive tax. And this is called the lifetime allowance. And the lifetime allowance is currently £1,073,100. So that's quite a high amount and a nice problem to have, I suspect, for many of us. But your NILGOS pension scheme is one of the best pension schemes in the UK. And you can eat up quite a bit of your lifetime allowance, especially if you've been a member of the scheme for quite a substantial period of time. Now, in Sarah's case, the predicted value of her NILGOS benefits at her retirement age is £286,646, which is using up 26.71% of her £1,073,000 and £100 lifetime allowance. So in Sarah's case, she's got plenty of scope before she comes close to getting close to that maximum lifetime allowance amount. But if you take a look at your statement and see that you're going to be using up more than Sarah, perhaps around more than 80% or so of that lifetime allowance, it would be something to be careful about and make sure that you've got plans in place to not overfund your pensions, because if you do, you can face some pretty excessive tax charges. So what we've broken down there then is how your NILGOS benefits are calculated and how that information is laid out on the annual benefit statements you receive from the NILGOS scheme. And I hope that's made things a little bit clearer for you. So when you next take a look at your statement, you can see how your benefits have built up over a period and how they've been calculated to give you a better understanding as to what your pension benefits are predicted to be at retirement. Okay, so let's continue with our case study with Sarah here and see what her plans are for retirement then. So Sarah's decided she doesn't want to work until her normal pension age of age 67 and would actually like to retire at age 64 instead. Actually feels she would like to retire a little bit earlier to allow her to enjoy the finer things in life, such as spending more time with her family and being able to go on some holidays while she's still at an age where she's physically and able enough to fully enjoy them. Now, you'd think that just going 3 years early wouldn't have too much of an impact on Sarah's annual pension amount of £14,277, right? I mean, in reality, that's actually only 36 paydays early that she's looking to go there. Well, in actual fact, by Sarah retiring just 3 years early and accessing her NILGOS pension benefits at age 64, it actually wipes off over £4,000 of her annual pension income, which is a massive hit for her to take. So why is there such a big hit to Sarah's annual pension amount then? Well, it's because, first of all, the number of years of membership in the pension scheme is reduced. So Sarah will be missing out on 3/49ths of her annual pension by going 3 years early. And secondly, because NILGOS will apply an actuarial reduction to her annual pension amount, as the pension scheme knows they will now need to pay Sarah a pension for 3 years longer than they would have needed to if she'd retired at age 67. And it's that double whammy effect, really, of Sarah reducing the years of membership in the NILGOS scheme and the actuarial reduction applied by the NILGOS scheme that causes that significant impact to Sarah's annual pension amount. And remember, it's not just 1 year that Sarah's going to have to deal with this £4,000 reduction. This has actually set the tone for the rest of her retirement. And if Sarah's going to have a long and fruitful retirement, she could be living for another 20, 25 years perhaps. And that's a lot of money per year that she'd be missing out on. Now, there might be some very good reasons as to why Sarah does want to retire at age 64, but she would need to think long and hard about as to why she does want to retire early, as £10,253 a year is a lot less than the £14,277 a year she would have been entitled to if she didn't retire early. And some of you here today might be thinking that you would like to retire early, but how do you feel about having that significant impact on your annual pension amount? How important is it for you to be able to retire early? And if it's that important, are you prepared to do some additional saving to make it a reality? Okay, so we've shown earlier today then that if you have any membership in that final salary 80th section of your NILGOS scheme that ran up until the 31st of March 2009, you'll be entitled to an automatic tax-free cash lump sum of 3 times the annual pension amount you're due from that 80th section. And if you've got no membership in that final salary 80th section, you would have 0 entitlement to an automatic tax-free cash lump sum. But that doesn't mean you can't decide to take tax-free cash from your NILGOS pension scheme when you retire. So whatever pension scheme you belong to now in the UK, you are allowed to take up to 25% of the benefits out as a tax-free cash lump sum. So when you get to retirement, you've got the option that you can decide to exchange some of your yearly annual pension income in retirement to take more tax-free cash, which sounds like a good idea, doesn't it? Everyone likes the idea of getting money on a tax-free basis. But what happens to your NILGOS pension if you did decide to take tax-free cash from it? Well, let's have a look here. So you have your annual NILGOS pension amount in retirement, whatever the amount is in your case, and you can decide to commutate £1 of your annual pension income in exchange for £12 of tax-free cash, which on the face of it doesn't sound like a too bad of a deal there. But in reality, that's a whole £1,000 of guaranteed pension income per year that you're losing for every £12,000 of tax-free cash that you take. So you'd actually need to think long and hard about this, because if you think about the average life expectancy and how long we all might expect to be around in our retirement, it might not work out to be such a good deal. And that's because that £1 of pension income that you're giving up is absolutely worth its weight in gold. And that's because not only is it guaranteed monthly income paid year in, year out until you die, but crucially, it's index-linked income that you're giving up. And that £1 isn't going to stay as £1. It's going to go up and up by whatever the CPI is. So if you leave that £1 of annual pension income alone, in all likelihood, you're going to be very glad that you made that decision, as you'll now have an income that does have the benefit of having that index linking attached to it, rather than the quick win of getting £12 up front of tax-free cash. So the question then that you would really need to pose when you get to your retirement is, should you take your full annual pension amount that you're eligible for, or decrease that annual pension amount that you're due to receive by taking a larger tax-free cash lump sum? So if we take Sarah as an example here, we know that Sarah's standard NILGOS benefits, where she doesn't give up income to take more tax-free cash, she's entitled to that full annual pension amount of £14,277 a year. And remember, that pension income is paid year in, year out on a monthly basis for the rest of her life. And not only that, it will be increasing by CPI each year, the Consumer Price Index, where the annual pension amount will be going up year on year based on the CPI increases. And the index linking element, as I've already mentioned, is really one of the more valuable parts of the NILGOS pension scheme. Just looking at this tax year, where CPI is currently running at 9.9% for August, and it's expected to be going up further still as we get into the latter parts of this tax year. And you can really start to see the value that index linking provides to your NILGOS benefits. And not only that, but remember that if you die whilst in retirement, your pension does not die with you, as your surviving spouse or partner will also be entitled to a proportion of the pension you were receiving until they pass. And again, this spouse or partner's pension will also be increasing in line with CPI too. And as we've seen with Sarah, that amounts to £4,634 a year as a spouse or partner's pension. Now, when it comes to exchanging annual pension income for tax-free cash within NILGOS, there is always an upper limit, a maximum amount that you're allowed to exchange for tax-free cash. And everyone will have different maximum amounts that you're allowed to take from your NILGOS pension scheme, with a maximum of 25% of the total capital value of your NILGOS benefits being able to be taken back tax-free. So in Sarah's case, the maximum amount that she's able to take back as a tax-free cash lump sum from her NILGOS pension scheme, based on her annual pension income of £14,277, is that figure there of £94,074. Now, if Sarah did actually decide to convert her annual pension income on that £1 annual pension income to £12 commutation exchange rate factor, and take that maximum tax-free cash amount of £94,074, she would actually do some pretty considerable damage to the amount of annual pension income she'd be in receipt of in retirement. It would actually mean that Sarah's annual pension amount would decrease by a massive £7,839 every year. And you could actually look at it along the lines of, if she lives longer than 12 years in retirement, she'd have been better off leaving the standard pension amount as it was. So when we take a step back and examine what this would mean for Sarah, it would mean that Sarah's reduced annual pension amount would have plummeted all the way down to £6,438 a year from that £14,277 she would have been entitled to and receiving had she left her annual pension income intact and not converted that annual pension income for tax-free cash. And remember, the higher the annual pension income is, the more it's going to grow in actual monetary terms due to that linkage with the Consumer Price Index. So coming back to that question you can see at the top of the screen there about whether to take more tax-free cash from your local government or your NILGOS pension at retirement. Well, it rarely is the correct thing to do from a financial perspective, and it's usually far better to leave your annual pension income alone, where you're going to carry on benefiting from the fuller annual pension amount that you're eligible to receive in retirement, and have the index linking attached to that full pension amount. The only way you could really see commutation to tax-free cash as a good deal is if, unfortunately, you're not going to be around that long in your retirement. In Sarah's case, then, she decides to leave her annual pension income as it is, the full amount of £14,277 a year, and not convert any of that pension income to tax-free cash. But Sarah, as a NILGOS member, does have another option that allows her to build up an additional tax-free cash lump sum for her retirement that doesn't have any detrimental effect or impact to her valuable NILGOS pension benefits. So the local government, with NILGOS shared cost AVC arrangement, she can save additional money for retirement in a remarkably tax-efficient way, where she saves on tax and national insurance each time she contributes into the arrangement, and she's still able to take the whole AVC pot of money she's built up all back as a tax-free cash lump sum, as long as she takes the shared cost AVC at the same time as she takes her main NILGOS pension benefits, and as long as it's within certain limits. And everyone here today, as you're all current members of the NILGOS pension scheme, you are also able to make use of the shared cost AVC arrangement that allows you to build up an additional pot of money for your retirement that you can potentially take all back as tax-free cash, a benefit that's exclusively available to you with you all being members of NILGOS. So by saving into a shared cost AVC, you're effectively getting the best of both worlds, where you're able to take your full annual unreduced NILGOS pension amount and also take a tax-free cash lump sum in addition to that via your shared cost AVC pot of money you've built up. Now, this tax-free cash lump sum that you can build up within a shared cost AVC can come in very handy if you're someone who just wants to have an additional pot of money in retirement to spend on holidays or luxury purchases, or just having perhaps the peace of mind in having a chunk of money in your bank account for rainy days to supplement your main NILGOS pension amount you'll be receiving. But not only that, the shared cost AVC can actually help facilitate an earlier retirement too. So let's take a look at what Sarah's plans then are for her retirement. So we know that most people would want to retire earlier than normal pension age, which is now aligned to your state pension age. So how will saving into a shared cost AVC help you do that? Well, let's have a look at Sarah here. So Sarah reaches the age of 64 and she decides to retire 3 years earlier than a normal pension age. And due to this, she accepts that her NILGOS benefits will be lower because she'll have fewer years in the NILGOS scheme, and lower still due to the actuarial reductions that are placed on her NILGOS pension. So what Sarah did is she contributes into the shared cost NILGOS AVC in an extremely tax efficient way by getting a double tax break on her income tax and national insurance. And then she takes the whole AVC pot of money she's built up all back as a tax-free cash lump sum when she takes her AVC at the same time as her main NILGOS benefits. And Sarah uses a tax-free lump sum from her AVC to help her bridge the gap between retiring early and then getting a state pension at age 67. So ultimately then at age 64, Sarah has a tax-free lump sum to do the things she wants to do when she has the good time and good health to do them, whether that's going on holidays, replacing the car, spending more time with the family. She's now got control. So that's an example there of where Sarah wanted to take the whole AVC pot of money she'd built up all back as a tax-free cash lump sum at the same time as she takes her main NILGOS pension benefits. But what if she wanted to access her AVC pot of money before taking her main NILGOS pension? So this is a relatively new option which became available when pension freedom rules came into place in 2015. So as long as you're over the minimum retirement age of currently age 55, you've got several options available to you. You're no longer forced to buy a financial product such as an annuity with your pension pots, and you've now got the freedom to leave the money invested and withdraw funds as and when you want to. So as we know, Sarah wants to retire 3 years early at the age of 64. And in this particular example or case study we're going to look at now, she's deciding to use the AVC pot of money she's built up to bridge the gap between her leaving work at age 64 and then accessing her main NILGOS pension benefits at age 67. And by doing this, it means that Sarah will not have an actuarial reduction on her main NILGOS pension benefits and therefore preserve some of that worth its weight in gold index-linked pension income. So in this particular example we're going to look at now, Sarah's basically decided to live off her AVC pot of money between the ages of 64 and age 67. Now we have made an assumption here that Sarah's managed to build up a fairly sizable pot of money in her AVC amounting to £48,000. And the reason we've used this assumption will become a little bit clearer in a moment. But £48,000 is a very attainable figure for Sarah. And to give you an example, if she was making a monthly £250 AVC contribution for around 13 years or so, it would mean that Sarah, in all likelihood, would have built up an ABC pot in and around that £48,000 figure. Okay, so Sarah gets to age 64. She stops work. She's left her main NILGOS pension scheme where it is. She doesn't access it. She's defers taking it until age 67 to avoid those actuarial reductions. and she decides to transfer her shared cost AVC arrangement into a personal pension, which allows her to gain access to her AVC before she takes her main NILGOS benefits, and she withdraws money from this personal pension that she's transferred her AVC into. And this is where Sarah's got a little bit clever as to how she accesses the money within the personal pension that she's transferred her shared cost AVC into. So essentially, what Sarah does in the first year of leaving work at age 64, she withdraws £16,000 from the personal pension in that first year of leaving work at age 64. Now, when Sarah takes a £16,000 withdrawal from the personal pension, 25% of it is automatically tax-free. So £4,000 in Sarah's case is automatically tax-free. Now, remember, you are allowed to earn a certain amount of money in a tax year before you're due to start paying tax. It's called the personal allowance, and this tax year is typically £12,570 that the UK government allow you to earn before you're due to start paying tax. So once Sarah's taken £4,000 of her £16,000 withdrawal automatically tax-free, it leaves her with £12,000 of her withdrawal that she may have to pay tax on. But in Sarah's case, she's not in receipt of any other forms of income. She's left work, and therefore the £12,000 that of a withdrawal that she may have to pay tax on can also be taken tax-free retrospectively. And Sarah does this exact same thing for each of the 3 years that she's not working, at age 64, age 65, and age 66, where each of those years she takes a £16,000 withdrawal, £4,000 of it automatically being tax-free, and the other £12,000 falling under the personal allowance threshold, so she can retrospectively claim the tax she paid back on that as well. So to sum up here, Sarah's done a great job in planning for her retirement, as her AVC pots allowed her to retire 3 years early at the age of 64 by bridging the gap between her leaving work and then accessing her main NILGOS pension benefits and state pension at age 67. And she still managed to take the whole pot of money she'd built up within the AVC all back tax-free. So essentially, the bigger your AVC pot is, the earlier you can retire and bridge the gap between you accessing your main NILGOS benefits and incur less or no actuarial reductions on those main scheme NILGOS benefits. And in Sarah's case, her main NILGOS pension at age 67 gave her an annual pension of £12,905, which is quite a bit more than the £10,253 she would have been in receipt of if she had incurred the actuarial reduction by taking her NILGOS pension benefits at age 64 instead. Okay, so just some conditions and considerations in relation to the shared cost AVC. So you do have to be an active member of NILGOS to make contributions into the shared cost AVC arrangement. What I mean by active member is that you're currently making contributions into your main NILGOS pension scheme as it stands. As long as you're doing that, you can make contributions into the shared cost AVC. Now, you can't pay an amount into the shared cost AVC that will take you below the national minimum living wage requirements. And don't worry about this too much, because if you were to submit an AVC application, your employer will double check the amount you want to pay in on that monthly basis and make sure that it doesn't take you below those national minimum living wage requirements. But if you were ever interested to find out what your upper limit is, we've got quite a useful tool on our website, avcwise.co.uk, where you can feed in details like what your salary is and the amount of hours per week you're currently working, and it will tell you what the maximum figure is that you can pay in into a shared cost AVC and remain above those national minimum living wage requirements. Neither can you go below the lower earnings limit, or neither would you want to really go below that lower earnings limit. So if you were sacrificing enough from your salary over the full course of a tax year to put that money into the shared cost AVC, by the time you'd sacrificed money from your salary, it left your salary as being less than £6,396. That's where your salary would be going below that lower earnings limit of £6,396. And that's where you would actually start to see an impact in relation to the state pension benefits you're entitled to. So again, not many people would want that to happen, where you would impact on the state pension benefits you're entitled to. So it would say if you are looking to pay into a shared cost AVC, you'd want to make sure that whatever you are looking to sacrifice from your salary over the course of the tax year to put into the shared cost AVC, you won't want it to bring your salary below £6,396 within the tax year, because if you did, that's where you'd potentially start to see an impact in relation to the state pension benefits you're entitled to. You've also got the general government restrictions and what they allow you to pay into pensions to consider as well. So you've got the standard annual allowance. That's the amount that the government allow you to pay into pensions within a tax year and receive tax relief on. It's typically £40,000, although it could be impacted if you've previously drawn on a pension, because you can sometimes trigger what's called the money purchase annual allowance when you draw on a pension. That's where the government put further restrictions on what you're allowed to pay into money purchase pensions going forward and allowed to receive tax relief on. And currently, the money purchase annual allowance is £4,000 a tax year. We've also got the lifetime allowance to consider as well, something we touched on earlier on the webinar, where that lifetime allowance, as I've mentioned, is quite a high amount. It's £1,073,000 or so. So a nice problem to have if you've got that issue, but certainly something you'd want to keep an eye on if you are getting into the upper ends of the scale there. Do remember, as I've already mentioned, with the shared cost AVC, you've got flexibility in place in terms of the amount you're paying into the AVC. You can increase or decrease your contributions at any time. So you're not tied into the initial contribution amount you put on your application. You've always got that flexibility there to amend your contributions at any point. And lastly, opting out or leaving employment. So if you were opting out of your main NILGOS pension and not paying into that anymore, or if you were to leave your employer, you're no longer going to be making contributions into your main NILGOS pension scheme, and therefore at that point you can't make any further contributions into the shared cost into the shared cost NILGOS AVC. And then those kind of scenarios, any money you've already got in the shared cost AVC will remain invested in the fund or funds of your choice until you decide to access your AVC benefits in retirement. Okay, so to recap then, we've established that you can build up this supplemental pot of money within the shared cost AVC that you can potentially take all back as a tax-free cash lump sum without it having any impact on your valuable main scheme NILGOS pension benefits. And you get to make tax and national insurance savings on every AVC contribution you make, on the proviso the money you're paying into the shared cost AVC is due to have tax and national insurance taken from it by your employer. But let's just bring this to life for you a little bit here and see what these tax and national insurance savings will look like using an example here. So if you're a basic rate taxpayer, it would mean that you're paying tax at 20% on a proportion of your earnings and national insurance at 13.25% on any earnings you're earning above £12,570 in the tax year. So if you're someone in a similar position there and wanted to save £100 a month into a shared cost AVC, it would actually only be costing you £65.88 from your net pay to do it. And that actually is a saving there of £34.12 each and every time you make a £100 contribution into the shared cost AVC, purely based on those tax and national insurance savings you're making as the contribution goes into the arrangement. And if we have a look at what that kind of uplift equates to, so that amounts to a massive 51.79% uplift to your savings as soon as the money goes into the AVC. And if you're a 40% taxpayer, the savings are even greater still, with a potential uplift in the region of 76% on any money you're due to pay 40% tax on. Now, some of you here today might be currently saving money into a savings account or a cash ISA. Right at the moment, you'll probably be lucky to be getting around 2 to 3% interest on your savings. With the shared cost AVC, you're going to be benefiting from that huge initial uplift as the money goes into the arrangement, and really does allow you to save money for retirement in the most tax efficient way possible. Now, I appreciate the AVC is a pension arrangement, and therefore you can't access the money in a pension arrangement until you're over the minimum retirement age, which is currently age 55. But the comparison there is pretty stark when you're comparing the savings you could potentially be making within a shared cost AVC in comparison to other savings vehicles you've got access to in the marketplace. And this is what your employers set up for you, the ability to save money from your salary, allowing you to save on tax and national insurance on your contributions, and potentially be able to take that whole AVC pot of money you've built up all back as a tax-free cash lump sum at retirement with absolutely no detriment to your main NILGOS pension benefits, which is an absolutely fantastic benefit for you. Okay, so importantly then, how would you go about applying for a shared cost AVC? Well, the first step is to go to our website, avcwise.co.uk, and log into your account. And on the home page, scroll to the bottom of the page, and you'll see the application buttons. And just click on the new application button. You then just need to enter your details and select the fund or funds you want to invest in. And within the application form, you'll have the opportunity to download the fund guide document, and this will give you details about all your available fund choices, where you can read through that document and come to a decision as to where you would like to invest your AVC contributions. Now, the AVC arrangement, the shared cost AVC arrangement, is an investment-based product, and as with any investment, you could get back less than what you've paid in, but all the funds are there with the intention of increasing your AVC pot of money on top of what you've already paid in yourself. And you've got the flexibility there to change your fund choices at any time. You're not tied into the initial fund choice you put down on your application. You can always make changes to your fund choices at any future point in any case. And once you submit your application, that will then make its way to your employer for them to do their checks on. And on the basis then on the basis that it's accepted by your employer, your shared cost AVC will then be set up with your AVC fund provider, and then your AVC contributions will then start to be taken from your next available payroll, which is typically the following month. Now, if you're someone here today that's already currently paying into a shared cost AVC arrangement with us here at AVC Wise and wants to amend your shared cost AVC contribution amount that you're currently paying in, it's a similar process. Again, you'll just need to go to our website, abcwise.co.uk, and log into your account. Head to the My Shared Cost AVC page and click on Amend Contribution Amount. Enter the new total monthly amount you want to contribute into your AVC, and your employer will then verify that amendment application. And then your amended AVC contributions will then start to be taken from your next available payroll, which, as I say, typically the following month. Now, I appreciate that some of you may need some extra help when it comes to setting up a shared cost AVC. So you do have the opportunity of booking a one-to-one meeting with us, and that might be with myself or one of my fellow retirement education specialists here at AVC Wise. And the meeting lasts up to around 20 minutes or so, and it takes place on Microsoft Teams. And it's where we can give you a helping hand to set up your shared cost AVC, or if you're looking to increase your AVC contributions. And we can look at things such as working out the maximum amount you can hold in your AVC and take all back as tax-free cash, or looking at what you can pay in to maximize your tax and national insurance efficient contribution, and really just ensuring you're making the most of the unique opportunity the shared cost AVC presents. Now, I will stress this option of a meeting is really only available if you're ready at this moment in time, in either to set up a shared cost AVC or to increase your AVC contributions that you've already got set up with us. So if you're not looking to do that immediately, I would say hold off booking a meeting with us and instead just come back to us at a future point when you are in either a position to apply or to increase your current existing contributions. But if you are ready to apply now or looking to increase now, would like that helping hand before you do that, drop us an email at support@avcwise.co.uk. We can then get a link across to you where you can book in a meeting at a convenient time and a date for you. Some considerations here for us to be able to help you at this meeting is please do ensure that you have access to an LGPS projection to your desired retirement age. If your annual benefit statement has a projection for an age later than your intended retirement age, you can always log into your NILGOS self-service portal to get a projection to your desired retirement age there. Also, if you've already got an AVC arrangement already in place, try and get an up-to-date valuation of what your AVC pot is currently worth. And we'll also need you to have access to an up-to-date payslip. And please also do consider what you can afford to see less in your take-home pay each month too. And as you can see then, the bottom left-hand corner of the screen there, we're not providing any financial advice or investment advice at the meeting, but we can give you factual information and help you on your way to applying for the shared cost AVC. So just to reiterate, if you're ready to apply now or want to increase your existing contributions now and would like that meeting with us before you do that, send us an email to support@abcwise.co.uk and we'll get that set up for you. So further resources for after today then, please do have a look at the Knowledge Hub on our website because it's a very useful tool within the website where it allows you to find out how much an AVC contribution will cost you from your take-home pay. And can also try and give you an idea as to how much your AVC pot of money could be worth at the point you're looking to access it at retirement. And in terms of your pension statements then, you should have all recently received those. You can obviously get those in paper form that are sent out to you in the post, or you should be able to find them online. If you were to log into your NILGOS self-service portal online, you should be able to find details about your pension statement there. We've also got that website to the right-hand side, nilgosc.org. That's a generic website. It does go into a bit of detail about how your main NILGOS pension scheme operates and how the benefits are built up over the period of time that you're a member. Just before we do stop for questions, I just want to go through some useful pointers. So as I mentioned, if you'd like to set up an individual meeting with us in respect of either setting up a shared cost AVC or increasing your existing AVC contributions, send us an email to that email address at the top there, support@abcwise.co.uk, just requesting that individual meeting if that's something you would like to happen. We've got a live chat facility on our website. We can get a response to your questions in real time if you're looking for a quick answer to a question you've got. Or if you prefer the more traditional method, you can give us a call on that telephone number there. We're open weekdays between 9 AM and 5 PM. Also, the Knowledge Hub on our website, as I've just mentioned, we've got that useful calculator. There's plenty of useful information and tools on there in relation to the shared cost AVC. You can also find your organisation-specific frequently asked questions document within your ABC Wise account, and that's where we've compiled the A to Z of every question we've ever been asked about the shared cost AVC in one handy document. And lastly, if you're looking for more details about how your main NILGOS pension scheme works, you've got that website towards the bottom there, nilgosc.org.uk, and that goes into a bit of detail about your main NILGOS scheme. Okay, right. Well, let's see if we've had any questions. So Martin said, thanks for the info, Nick. No problem at all, Martin. That's exactly what we're here for at AVC Wise, to give you a bit of information about how your main scheme works and also highlight the benefits you've got being NILGOS members with their shared cost AVC arrangement. And Damon, again, along the same lines, thank you, Nick. No problem at all, Damon. Glad you found today useful. And again, Christine, many thanks. No problem at all, Christine. My pleasure. And as I say, hopefully you found today useful. Okay, well, let's get today's webinar wraps up then for you in that case, because I appreciate we're just gone over our allocated time. So I appreciate those of you that have stuck around today. So with the information we've covered today, then you're now hopefully going to have a better understanding as to how your NILGOS benefits are calculated on your pension statement and what this means in terms of what your NILGOS benefits will be at the point of retirement. And although the NILGOS pension scheme is no doubt an absolutely fantastic arrangement to be in, you need to ask yourself, is it going to be enough to achieve those goals you've got for your retirement? Is working to state pension age something you're happy to do? And if you would like to retire earlier, are you going to have enough money to bridge the gap and mitigate the costly actuarial reductions that can be applied to your main NILGOS pension? And the shared cost AVC allows you to save additional money for retirement in a remarkably tax efficient way, and then have the unique opportunity only available to NILGOS members, where you can potentially take the whole AVC pot of money you've built up all back as a tax-free cash lump sum at absolutely no detriment to the benefits you've built up within your main NILGOS pension scheme. And the sooner that you take action and start to plan for your retirement, the easier it will be for you to reach your retirement goals. And trust me, your future self will be grateful for the action you can take today to make your retirement dreams become a reality. Thank you for your time today, everyone. Really appreciate that. I'll let you get off and have a good evening, everyone. Thank you. Bye-bye.